So Timbuktu, Ghana, Mali, Sumanguru, you know what you're shown. Where what you're shown. So Timbuktu, Ghana, Mali, Sumanguru, you know what you're shown. Manchester, you know Sumanguru, you know what you're shown.
This program is brought to you by World Remit, a fast, reliable and better way to send money.
World Remit helped me give you the best start in life. Even if I couldn't be there to see it. I know it wasn't easy comparing yourself to your friends, but the money I sent home meant that you could be right there alongside them today. I'm so proud to be your mother, almost as proud as you must be now that you're starting an incredible new chapter.
Good evening, ladies and gentlemen, and welcome to the 13th edition of the Ghanaian Community Awareness Forum, broadcast to you live on Zoom, Facebook, YouTube, working in partnership with Ghana Union, UK, the Western Region Nurses Association, UK, the Nightingale West Nurses Association, UK, and the Western Region Association of Nurses, UK. This program is supported by the Ghana High Commission and Omega Live, transmitting it to you around the world. Tonight we have a very educative program, very interesting. We welcome all audience to this program. My name is Emmanuel Pisikwesin, the chairman of Ghana Union. And so on that note, we will be going straight to some of the few things that we've always made you aware. As the program continues, we will hope that you will follow a few protocols, which I'm sure most of you who are used to our programs would have been aware by now, but it's worth repeating that on this program, we will make sure that all audience will be muted, except when you are about to ask a question during the Q&A sessions. Audience, where possible, please say your name and show your face when speaking. And if you want to ask a question on Zoom, please raise your hand using the Zoom icon. And if you're on Facebook Live, YouTube, please put your question there and we'll be monitoring it to make sure we can answer some of your questions as well. Audience will not have the right to share their screen except the speakers tonight. And where possible, please ask a question at a time and go straight to the point so that we can take as many questions as possible. I would like to thank the speakers who have volunteered their time and experience and expertise to share with us the knowledge they've gained in their field over the many years. And so this evening, I welcome you to two special guests who are here to talk about wealth management, pensions, protections, trust, wills, mortgages, and others that I'm sure audience will bring across. These are people who are versed in their field, have been there for so many years, have helped others to achieve in their course of investment, and have excelled in many fronts. Tonight, I have with you Alex Messentine. Alex is a chartered financial planner and a director of Fortune Financial Management, a partner practice of St. James Place Wealth Management. Alex has over 20 years experience in the financial advisory profession and has a wealth of experience in the fields of wealth management, financial planning, investment, and pensions. Before his current position, Alex worked for a number of advisory firms, previously specializing in the returning expatriate market, so he has a high level of knowledge and expertise of both offshore and onshore financial plans. He set up Fortune Financial Management around 5 years ago and looks after a client base spread around the UK, many of which are long-standing clients of his. Add to it, Alex is also a pension transfer specialist, which allows him to analyze and give appropriate advice on all manner of pensions, including more involved planning requirements with regards to defined benefit and final salary pensions. Alex is a fellow of a personal finance society, a level of which only less than 10% of UK advisors have reached this high level of qualification. Alex takes pride in developing long-term relationship with his client and is also accessible, friendly, and available in looking after his client financial needs and requirements. Let's welcome Alex Messentine to this evening's awareness forum. Thank you, Alex, for joining us.
Thank you very much for having me.
Thank you. We also have Betty Hammond, SJP. Betty Hammond is an executive vice president of Nesta. She's a wife and an amazing mother of 3. Her mission is to help people build a strong financial foundation for the future, with a special interest in helping families getting through their money, working hard for them, and as they work hard for it themselves as well. Betty is a specialist in financial education, meaningful protection of SME, debt freedom, and raising phenomenal leaders. Betty, tonight we are grateful to have you and welcome to the Ghanaian Community Awareness Forum. Thank you for joining us both. We have 2 special guests who knows what they are coming to tell you. And we have wide audience who are watching around the world, some on Zoom, as we can see some of them, others on Facebook that we cannot see live, but they are listening and will be watching the videos that come after that, and on YouTube. The program is also being streamed live on Omega Live TV, which is a Ghanaian community-based television network system that cut across all social media networks. I will go straight and introduce the first speaker tonight, which I've done already with the introduction. So Alex will take us through areas around investment in UK, pensions, and mortgages, and where possible, add to anything that he has under his belt for the number of years he has been in the field. Please take over from me, Alex. Thank you.
Lovely. Well, thank you for such a warm and fantastic introduction. Delighted to be here this evening. Lovely to see you all. And nice that we can obviously speak on Zoom to everyone wherever you may be in the country. So yeah, as I say, don't need to do much of an introduction to myself after such a great overview. But as I say, I'm a chartered financial planner and a fellow of the Personal Finance Society here in the UK. Particularly if we're talking about investments, obviously in the UK, we look after both clients that, again, probably for the audience we've got here tonight, clients that are based in the UK, but also that have been overseas at various times in their lives and have moved either over to the UK permanently or temporarily. So we've had experience of looking after more international clients when they come to the UK, and without stating the obvious, it's quite an interesting time in the UK for the investment markets and the economy in general, based on everything we've been through in the last 18 months. Certainly at the start of the pandemic 18 months ago now, obviously the markets in general terms were very volatile at the end of March and April, as they were all around the world. But then obviously things have stabilised. The reason for using that as an example is the fact that it's been an unusual period in the markets, and it's obviously something that we've never gone through before, but it highlights the fact that when we look after clients' money and their investments and their pensions, it shows that there can be these unexpected events over time, and every so often these events appear. See, COVID-19 was certainly standalone, unusual from the point of view of we've obviously never experienced something like that before. But if we go back in time, we had the financial crash back in 2007, 2008. You had the dot-com boom and bust in the early 2000s. So there's always something in terms of market behaviour that will affect investments and pensions. Where we come in is effectively to advise and position someone's investments as best as possible to steer them through the long term, and have conversations with clients to say, well, this is what's happening, but we've structured your investment plans in a particular way to weather as much as is possible the storm. And the big takeaway I would say is to look at investments, whether it's in the UK or otherwise, but over a longer period of time. Because, if someone if we're in the UK, looks at the FTSE 100, for example, on a daily basis, it can move quite extensively. But obviously we're looking at investments over a longer period of time, and that's where you'll start, you'll see the markets moving, sometimes fairly extensively in a shorter period of time. But if you're looking towards the long term, whether it's retirement, whether it's something that's 10 years away, then typically we can go back a long period of time. Markets always do go up over the long term. In the short term, they can be a bit more volatile, but that's where we will speak with a client, find out where their level of comfort is, because not everyone is going to have the same level of risk comfortability. So you might have someone that doesn't want to take much risk, and then we will set a portfolio up that's very risk averse. So it would be, in simple terms, something that's based in fixed interest or bonds or government gilts, that sort of thing. If someone is more balanced, you'd have a mixture of those type of assets and equities, stocks and shares. And then you have the more risk or adventurous investor that might have a lot more equities and be prepared to see a few more swings in the short term of an investment. But we can tailor that and obviously have a conversation to say, where do you sit from a risk point of view? Where's your comfort level? What's, in terms of how much someone's looking to invest, how does that fit in with their overall financial picture? Because it could be very different if someone's investing, say, £20,000 into an ISA and they're prepared to take a little bit more risk. If they've got a large pension and a large set of investments, might be a bit more cautiously managed. Whereas if someone has got a portfolio and that's all their portfolio in total, and for want of a better word, they can't afford to take the risk with it because that's what they've got and they need to treat that conservatively, then obviously we can tailor that to fit accordingly. So very much when we sit down with a client, it's very much bespoke, because not every client is different, and even two clients that might be on paper very similar in terms of the same age, the same occupation, the same term to retirement, they might have a completely different outlook between the two of them in terms of what they want something to achieve. So from that respect, we'll need to have very much a personal conversation with the client to find out what their needs and objectives and aims are. In terms of the types of investments available in the UK, what I'll do is just, I don't want to spend too long on a presentation, but if you can see the screen there, things we consider when we're looking at planning for someone's future, obviously looking at a monetary amount. That can be starting as a baseline with something like a pension, and it could be, and obviously we've got a lot of the nursing community here, so they might have an NHS pension, for example, which provides a backdrop to retirement. You might have property, and obviously we'll talk about mortgages a little bit later. And then from there, you'll have cash savings, which again, we would always recommend to have an element of cash savings, particularly classed as an emergency fund. And especially as we've experienced over the last 18 months, always expect the unexpected with life and with events. So have an element of savings and whatever feels comfortable, 3 or 6 months savings that's readily accessible. And then you move into investments. And what I always say, if someone were to ask whether you should have a pension or an investment, I would typically say, ideally, you'd want a proportion of both, because pensions are very good from the point of view, they're tax efficient, you get tax relief on them. The downside is obviously that they're effectively locked away until retirement. So therefore, if you were looking to save for something that's a little bit more short term, so whether it's children's education costs or a buy-to-let property and you're looking to save a deposit for, then you'll probably want something a little bit more accessible, which is where the investment side of things would come into. In terms of pensions and investments, we typically say that you would set some form of investment value up and take a percentage of that as an income at retirement. From a pensions perspective, it's always important not to forget that we do have a state pension here in the UK. And whilst the government keep pushing the age of the pension back, for younger people now to be pushed back to age 68, it still is I would say, a fairly attractive level of income based on the number of contributions you make into it. We're talking, as it currently stands, if you have a full state pension allocation, it's £179 a week. So not too shabby, all things considered. The other thing you've got to bear in mind with pensions is at the current time, there is a lifetime allowance, which in a nutshell means that's the maximum you can put into a pension and receive tax relief on it. If you go above that figure, they have a lifetime allowance tax charge on it. So when we speak with clients, if they're in the nice position of having a high level of pensions, it's always worthwhile having a conversation if they're at that limit as to how that impacts them and other issues, because if they are up to that level, you can always look at alternatives as well. Pension freedoms. Now, about 6 years ago, the government changed pensions quite extensively and made pensions much more flexible. So it used to be that you got to retirement age, you had to take your retirement pot and buy an income with it. Now, that income would pay you a figure for however long you were living for, and it potentially would pay a spouse an income if you were to die before them, but essentially that was all it could do. Now, the government in 2015, when they made pensions flexible, is they said, well, actually, you can take an income from your own pension at a level you think is sustainable. So, whereas it says at the top, 4 to 5% is a sustainable income, you could take more if you wanted to. Now, we would always have a conversation with the client and say, well, if you're going to take, let's be ridiculous, and take 15% of your pension every year as an income, it's going to run out a lot sooner than if you were taking 4 or 5%. But it is available to be able to do that. The other benefit that they changed 6 years ago was the fact that pensions are now inheritable. So if you've got a traditional pension where, not a final salary, I should add, but a pension where you're saving into it monthly and you can see it as a cash value because it's invested. If you were to die, then you can leave that to your next of kin or your family, or actually whomever you choose. So it nowadays doesn't have to just be a spouse. So that was quite a big change in the pension world fairly recently. On the flip side, with other than pensions, obviously a lot of people and a lot of clients have property and buy-to-lets, which again, just bearing in mind for those that do, obviously they will have certain void periods, so we need to build those into the equation. Investments, fairly wide ranging in terms of what investments can be. It can be something as tax efficient as an ISA, so you can put in your £20,000 a year, have it grow tax-free over the long term. You can have things like unit trusts, which you can use your capital gains tax allowance on. You can have bonds, which you get a different type of tax allowance on. So I would say there's, in choosing an investment, there's the wrapper itself. So that could be the ISA, the unit trust, or the bonds. And then there's what's inside it. So that's the investment itself. And that's where I was saying before is where we choose the funds to go into those investment wrappers. And that could be something very, very cautious, like bonds and fixed interest, as I was alluding to earlier. And it could be stocks and shares if someone's wanting to target some more growth. From a ultra conservative and cautious basis, these are the type of products that you would typically see and hold if you were looking at holding things that are very safe and very accessible. So things like your current account, your savings account, which based on the interest rates at the moment, which obviously benefits mortgage borrowers, that interest rates are low because lending is at an all-time low in terms of the rates, but obviously the interest you're going to get on your savings is unsurprisingly very low as well at the moment. Cash ISAs, again, can grow tax-free as well, but the rates on them, again, are fairly low. And the bottom one, national savings and investments, so things like premium bonds, which, again, have the security that they're protected by the government. The rates of return are a little bit better than savings accounts, but the overarching factor with all these type of investments is the accessibility to it. So you can put your money in, get a little bit of return on it, and know that you can access the money, and it won't be subjected to the stock market at any particular time. And then you have the flip side, where you have I would say the longer term investments, which traditionally you would say need to be invested for more than 5 years because of different periods of time where there might be a little bit more volatility, like we've experienced over the last 18 months. And this is where we go from pensions as being very, very long term, because obviously it's going to be in there till 60, 65, 68. And then you're going to have the other forms of investments, not pension related, but things like a stocks and shares ISA, and things like bonds and unit trusts that will typically be invested in more growth-oriented assets, and potentially depending on how they're invested, might be a little bit more higher risk. But with the flip side, if they are higher risk, then the main aim is obviously for better growth than they would be in cash. So if it's at all possible, it's good to spread it, to have some element between the two of them, so you get the best of both worlds. So I'll briefly skip over the tax relief. Tax relief is based on your upper tax rate, and you get tax relief on the pension at that level as it currently stands. And it might be that you have a company pension or a personal pension. It's how they all add up together, which obviously we look at and obviously projects where you are in terms of where you want to be at retirement. The other factor with pensions, going back to the changes they made 6 years ago, is that they've made them inheritance tax free as well. So when the day comes when you sadly pass away, and the government obviously work out their inheritance tax calculations and look at things like how much cash you've got, how much investments you've got, effectively pensions are ring-fenced away from that because they're inheritance tax exempt. So they sit outside of someone's estate for inheritance tax purposes. So if you've got a big pension, you don't need to add that into the figures and pay the nasty 40% inheritance tax. So that was quite a big benefit of the recent changes. So that's just a brief overview on tax relief. ISAs are fairly straightforward. Again, you've got the cash ones, you've got the stocks and shares one. The limits now are the same, so it's £20,000 for both. Also, we have junior ISAs for those of us with children, which is slightly lower limit of £9,000 a year. But obviously over the long term, that can build up to a fairly extensive level. Property is fairly straightforward. As we've seen over the last few years, the growth of property tends to always do well. It does have its disadvantages with things like the maintenance costs, a little bit more involved in terms of getting a mortgage, but in terms of the positives, yes, you can get mortgages against buy-to-let property, and that allows you the fact that you can buy a property with a smaller deposit, still get the rental income from said property, and obviously enjoy the growth that it could potentially do over the long term as a result of you being able to get a mortgage against the property. Downside, obviously, is that it's bricks and mortar, so it takes a little bit longer to sell than if you had shares in what's topical at the moment, BP or Shell, as we're all, a lot of us are experiencing the chaos at the petrol pump at the moment. But yeah, if you bought shares in Shell or BP, you can buy them today and sell them back again the same day or tomorrow. So it's just a difference in terms of how easy it is to get hold of your savings or cash within a particular plan, which is why we would always recommend having an element of readily accessible cash in a savings account or a current account. So as a nutshell, what we tend to do with a client, first of all, sit down with them, work out what the actual target is. So what is a client looking to do? Are they looking to save for a particular purpose? Is it saving for education fees? Is it saving for a property? Is it saving for a pension? How much income or capital are they targeting? Are they looking to save money for £100,000 in 10 years' time? Are they looking to have a pension that's going to pay them £2,000 a month at age 65? So that's the starting point. From there, we will look and see what's already in place. So it might be that you've got a pension at work, or a lot of people have a build-up of pensions if they've worked for 2, 3, 4 other employers in the past. So we'll look at what's previously there, and it might be beneficial that we'll sit down and work out and find old pensions, because it's quite surprising these days how many pensions people have simply forgotten about. And, you know, if it was 20 years ago, it could be worth, you know, a reasonable chunk of money if it's been invested for that sort of time. So from that, we know what you want, we know what you've currently got, and then we'll see where the gap is. So what do we need to do to get there? And that may be that we look at saying, well, to get to where you want to go, you might need to save a little bit more on a regular basis. So it might be that you need to put some more money into your pension monthly, or you need to put something into an ISA on a regular basis. So we'll have a conversation around that and work out some calculations on those. Following on from setting up the plan, the other important thing we do once this is all set up is actually reviewing the plan over time. So we can set the plan up today, but it might be for something that might be happening, let's call it retirement, in 20 years' time. So we don't set the plan up and leave it there, hope it all comes out where we want it to be in 20 years' time. The important thing is to keep reviewing it over time. So, you know, the funds, the investment funds we put in today might be the best ones today, but they might be other ones that are better or more suited in 3 years' time, in 5 years' time. As we've seen over the last year and a half, the stock market changes and the economy changes can change fairly rapidly or without very much notice. So it's about being adaptive and reactive to certain events. So the important thing is to keep reviewing it over time and making changes. Are we on track to where we need to be? Do we need to put perhaps increase the amount that we're saving towards retirement? And when we get to retirement, or when we get to that event we're planning on, the other important thing is how we use it. So going back to what I was saying about pensions, because they are flexible, it means we've got the other side of the spectrum is we've got a lot more choice about how we use them. So we don't necessarily need to say, today, I need to take £2,000 a month income from my pension. It might be that I need to take £2,000 a month from my pension today, but in 3 years' time, my state pension starts paying. So if the state pension is going to pay, let's call it £800 a month in 3 years' time, there might be a period of time, 3 years, 5 years, whatever it may be, when you do decide to retire, that you might need to take more from a pension and then scale it back slightly when the state pension comes into effect. And if you've got a flexible pension that enables you to do that, that often works very well, because it might mean the difference between waiting a few years to retire or being able to retire early. So that's the sort of conversations we'll have with a client. But the main factor is that it's adaptive, it's flexible, and it's continually being reviewed over the short, medium, and the long term. So from the point of view of the investment side of things is very important, because that's very much dependent on where someone's comfort level is, where their aims and targets are. But it's also the structure as well. So it could be getting the right vehicle that the funds sit in. So it might be the pension, it might be the bond. It could also be, as well as saving for retirement or saving for a property purchase, it might be that you're needing some advice around inheritance tax planning in general, or passing your wealth onto the next generation. So this is where it might be about putting funds into trust, whether to mitigate against paying tax, or to protect the next generation, which Betty will come on to when she speaks. But you know, everyone has a different requirement when they come and speak to a financial advisor or a financial planner. The main takeaway is that everybody is individual in their requirements and everyone has a different need. Therefore, the advice that we would give is very much personalised and very different from one person to the next. Obviously, there's a lot of synergy in terms of the funds that we access and the products and plans that we put into place. But you know, from a client perspective, it's very much individual advice and tailored. that's where we would build the relationship for the long term with a client, and have those conversations and discussions over time. And when we do work with clients, we often find that the level of understanding they have improves over time as well, because obviously, someone that's not in the pension world or not in the investment world predominantly doesn't have the same level of, without utilising jargon, but doesn't have the same level of understanding of all the different permutations, options are involved. But over time, by having conversations with me or with a financial advisor, the level of education, which Betty does a lot of work on, increases over time. And that's the end goal, is to not only set a plan and get to the end goal, but also to help someone understand what they're invested in, where they're invested, why we're doing a particular piece of work, what it's there for, why we'll be doing this particular way of doing things instead of another. So it's important to understand what we're doing, what we're recommending, and what we're advising on, as well as obviously hitting that goal of what we're advising on, whether it's retirement or investing a lump sum or education fee planning or inheritance tax planning. So all those things will come into it, and yeah, a lot of good conversations come out of it as a result. So yeah, definitely lots of things to talk about. So that's, I think I'm roughly about half an hour. So hopefully everyone found that of benefits, and I will look forward to hopefully answering lots of questions in the Q&A a little bit later on.
That's great. Thank you so much, Alex.
Pleasure.
A lot of information, and I'm sure people will be ready and be back with you with all the questions that they have. Thank you.
Look forward to it. My pleasure.
I will now call on Betty, please, to take over. Betty, who will be dealing with wills, trust, and other aspects of the issues that Alex has highlighted. Thank you.
Thank you so much, Emmanuel, for that wonderful introduction. And thank you so much, Alex, for that excellent presentation. So well done. So like Emmanuel said, my name is Betty Hammond. I'm an Executive Vice President for Genister. So my background is financial services. So going back to 10 years, I used to be a financial advisor for Nationwide. So I'm DIPFA qualified, fully qualified to give financial advice, but got married, had children, so just went off on a tangent, and then later found Genister. I believe in the mission of my company, which is to provide financial education, because I realized that most people have products, most people have all these services we talk about, but they don't even understand what they have, especially in the times we find ourselves in with the pandemic, with the economy, the way everything is going. It's always good to take a step back, understand the products that you have. Where is it that you are going? What are your goals? What are the goals you have for your family before you can make an informed decision? So we provide education around the whole financial bits. We look at a holistic approach. So we give personalized financial education to our clients. So like any proper structure, the building must have a good foundation. And that's the mission of what we do in Genister. So I'm going to be sharing my screen. Okay. Yeah. Okay. So this is your journey to financial freedom. So know your destination. Preparing for your journey, you always use a satellite or GPS or whatever you have in your car. So when you're going on a journey, looking at the destination you're going, you put in the postcode, and that would help you prepare for your journey. We show you whether it would take an hour, 2 hours, 3 hours, or just a couple of minutes. So it's very, very important that you know your destination and you prepare for the journey ahead. So where do 68-year-olds stand, which is the retirement age at the moment, and it keeps moving, as Alex said, year by year. So one person out of 100 people reaching retirement age, one person is wealthy. 4 are financially independent. 41 people are still working, and 54 are actually dead broke. My question to you is, which category will you fall into if you change nothing about what you're doing right now? So financially, where are you now? How much debt do you have? What are your earnings? How much savings do you have? That is the question I have for you this evening. So financially, where do you want to be in the next 12 months, right? A lot of people say, yes, I want to make £1 million. I want to make £100,000. But where do you actually want to be with what you are currently doing? Is it realistic? Have you set SMART goals? Is it specific? Is it measurable? Is it attainable at all? Is it realistic? Is it something that you can work towards, or you are just giving yourself a number? So knowing your destination, preparing for the journey, first of all, you have to set some goals. Have your own personal goals, have goals for the family, and the goals have to be clear, concise, mental picture, which is called the CCMP. So you have to conceptualize this. You need to have a mental picture about what you want to achieve, and you need to have a desire. It all starts with having a desire, and then you add the strategy, which will help you get to your destination. So emergency fund, what do we mean by that? No one will travel in a car on a long journey without making sure they have a spare tire in the boot. Because what happens if, let's say, you get halfway and you realize that, listen, the car is not moving anywhere, you have a puncture in the tire. What do? So you always make sure you have a spare tire. That is where emergency fund comes in. So stay out of debt. Emergency fund is key, because that is what will help you when you lose your job, which a lot of people have lost their jobs during this pandemic. When you have major car repairs, when you have any medical emergencies, as you know, with the NHS, there's a long waiting list for so many things. And when you have major home fixes. So when you have an emergency fund, what it does is it keeps debt from your door, because if you don't have that, that is when you now go to your credit cards or go back to loans. So the 10-10-10-70 strategy, you must have a strategy, as I talked about. 10% of income is given back to charity. 10% of income goes towards savings, emergency fund, then savings to spend. That is where the emergency fund comes to play. Then 10% of income for your future, which Alex talked a lot about, investing for your future. Then 70% of that net income actually goes towards expenses. So my question to you is, are you living the 10-10-10-70 strategy, or everything goes into expenses? So emergency fund, start with £1,000, right? Only for true emergency, because we have some emergencies that are not true, right? You have emergencies where a friend will call you and then ask you for a loan. That is not an emergency. Yeah, you can help the person out of goodwill, but then emergencies are what we looked at earlier. So aim for 3 to 6 months of expenditure. So start, you don't have to start with, 2,000, 3,000, or have a lump sum, but you can start small by small. You can start with putting away £200, £500, but then your aim is to get 3 to 6 months of expenditure saved for a rainy day. So seatbelts and airbags. Most people on here wouldn't travel in a car without making sure that everybody was buckled in. When it comes to protecting your family, a lot of people don't see the importance. In the pandemic, I personally received a lot of messages, GoFundMe here, GoFundMe there, a lot of them came through, right? But then making sure that you protect your family, making sure that you are securing their future, right? You don't buy life insurance because you are going to die. But you buy life insurance because the people you love most are actually going to live. So protecting your family is very key and is the foundation to whatever you do towards your family's future. So how life really works. So let's look on the left-hand side. Today, you might have young children, high debts, and a house mortgage. So you would agree with me that anybody in this region, loss of income will actually be very devastating. Then if we move to the right, at retirement, you have grown children, lower debts, hopefully mortgage paid off, and some form of retirement income will be needed here, right? So on the blue line, in the early years, you may need a lot of coverage. You may need your life cover, you may need your serious illness cover, income protection, medical insurance, and all that. But in the later years, you may not. We call that you rent wealth in the early years. Then on the green line, in the early years, you don't have money because you are paying for children's tuition, you are paying for a house mortgage, which can be very expensive. But in the later years, you had better have money. Otherwise, you'll be found wanting. There's no excuse at all. We call that accumulation of wealth. You need to make sure you have these two vehicles running in parallel positions. So as you have your life cover, serious illness, all the protection in place, fantastic. But you also need to make sure that you are saving towards retirement. So my question to you here is that, where do you think you are on this diagram? Are you more in today, at retirement, or you are in the middle? So you know what you have to do. So protecting your family, how life really works. We look at the dime, which is debts. We look at income, we look at mortgage, and we look at any extras you may have, including children's university fees, including funeral expenses, including leaving a legacy. But you always have to make sure that you cover your debts, because one interesting thing that people don't know is that you can pass away and your debts, depending on your estate, can be passed on to your spouse or to your family. So it's very important that if you have debts, you do consider it when you are taking a protection plan. You have to look at your income, very, very important, because without you, you are the breadwinner. You are the biggest asset the family has. So without you, how would their children keep up? How would bills be paid? So very, very important. Then mortgage. You need to make sure, if you're on here, you have a mortgage, you need to make sure the mortgage is protected, right? So that at the very least, if you were to pass away or to die, the mortgage will be paid. And then the extras is all the other things that you can think of to make your family better off. So the highway code, most people have gone through this, and you need to know the rules, right? Before you pass your driving test and all that, you have to go through that, because that is what will help prevent accidents, will help you to make sure that you get to your final destination. So let us imagine, right? So let's imagine this, right? We are looking at the debt trap now. Let us imagine you have £3,000 on a credit card at 20.9% APR. Every month you pay off the minimum of 2% or £5, whichever is greater. You don't make any new purchases, so you've just got the £3,000 to pay off. So how long do you think it would take you to pay off the loan? Okay. The answer is 90 years. That is how long it would take you to pay that loan off, just making the minimum payment. How much would you pay in interest charges? Is it the £3,000? Is it £12,000? Or is it £23,000? I bet you didn't get the answer. £23,000 is what you will pay in interest charges if you just make the bare minimum on this. So the rule of 72. The rule of 72 approximates the number of years it would take to double your money at a fixed rate of interest over the period. So the rule of 72 is calculated simply by dividing 72 by the rate of return that your money earns. So if we look at the first column, let's say you stick your £10,000 with your bank paying you 3% in your cash ISA. I'll call this bank Miracle Bank because no bank is at the minute paying even 1% on any cash account, right? So what you do is you divide 72 by 3, which will give you what? 24. So it shows you that every 24 years, your money doubles. I don't know about you on here, but I can certainly not wait for 48 years to get a return of 30,000 on 10,000 pounds savings. So if we move on to the second column, now we've doubled your interest from 3 to 6%. So again, with the same rule in mind, you divide 72 by 6. This time it's going to give you 12. So it shows you that every 12 years, your money doubles. But look at what happens in 48 years. Your money hasn't just doubled from 40 to 80, even though you just doubled the interest. But what has it done? It has quadrupled. That is the rule about the money game that most people are not aware of. Just by doubling of interest, you can actually quadruple your returns. So what do you think the banks do with your money? Yeah, they move it to their lending department or they invest it for higher returns, right? So let's say for this scenario, they are investing it at 12%. Again, the same rule in mind. You divide 72 by 12, which will give you what? 6. So it shows you that every 6 years, your money doubles. In 24 years, your money has already quadrupled, right? In your mind's eye, what do you think the figure will be in 48? I bet you didn't get the answer. 2,560,000 pounds is what the banks will make. If you are lucky, you get 40,000, right? So you need this rule to work for you rather than against you. Many people have money in savings account, paying them less than 1%, and they still borrow same amount of money. I've seen it so many times with a client I have, the same amount they've borrowed from the bank paying 24.7%. So your money is not working hard for you. So how to beat the banks? At every roundabout, you see so many things. So you need to figure out how you can get off the roundabout. So let's look at debt freedom. The cost of debt is more a function of time, which is the payoff date, than the interest rate, right? So this is a typical family. They have a number of credit cards, 2 loans, and a personal residence mortgage. So the average amount that this family owe is 203,583. The average interest they are paying is 5.26%, and the average monthly payment is 1,911. It is projected to be paid off January 2033 with a projected interest of 152,440. So let's look at the solution. Is debt staggering, right? So manage debt with additional principal payments. So your debt situation with an additional £50 per month towards the principal, right? What would happen? Now you would finish paying off this debt in 2023, which means that you are saving yourself 10 years of your debt due date, right? And saving you an interest of 55,877. So here, what we are showing you is that the longer you prolong a debt for, the more you pay interest, right? So you need to make sure that you pay off your debt in the quickest possible time. And how do you do that? By adding additional payment towards the principal. So fortnightly repayment option, what do we mean by that? To gain more value for your money, we believe in the concept of the mortgage acceleration. If the homeowner makes bi-weekly payments, the principal can be paid off in full in less than 20 years, right? So if you look at the first diagram I have on here, we have principal owed of 110,823. So the person borrowed 150,000. So the total cost after the interest is also paid is 358,003, which means that the interest this family would have paid is 208,208. So if you look at the second diagram, by putting in the fortnightly repayment option, you would save yourself some years. You save yourself some years as well as 52,281. So you save yourself 5 years off your mortgage as well as that lump sum of 52,281. So we've talked about debt stacking. We've talked about fortnightly mortgage payments. Now we go to the cash flow quadrant as well, right? So we've talked you through the rule of 72, how you can make your money work as hard as you work for yourself. So bank accounts are for the short term. You invest £10,000 at 4% in your local bank, you earn £400 in interest for the year, but you pay £80 in tax on that interest at 20%. So your net earnings are 320, resulting in a balance of 10,320. But take a hypothetical inflation rate of 3.5% and see what happens to your buying power. So that is 10,320 minus the 3.5%, which is 36120, and you end up with 9,958.80, which assumes a 20% rate of tax applies. So your buying power has actually gone down. The net loss you would have made would be £41.20. So property, investing in a property. So we have this 2-bed semi purchased July 2012, purchase price of 42,000. So the deposit is 25% because it's a buy-to-let property, which will mean that you are going to be putting down 11,450. The cost of refurbishment is £2,200. So the closing fees will be 3,500. So total investment you would have made is 47,700. But look at it here. Rental income, 48 times 12 will give you 5,760. Divide that by 47,700 and you would have 12% yield. So investing in properties is also key. We heard from Alex. Alex talked a lot about investing in the stock market. Fantastic. You know, you always need to have a balanced portfolio. So it's not good to even put everything in property. You also need to make sure that you invest in the stock market, as Alex rightly said. So here at Genista, what do we do? These are some of the products and services that we help our clients, and it's bespoke for our clients. But it all starts with the financial education, right? So all products and services are mission focused towards helping the clients reach their financial destination. So we have products like buildings and contents, general insurance, investment, PPI, claims, debt solutions, mortgages, and life assurance. But it all starts from, first of all, having a financial review, which is bespoke for you before products before we advise you on, or we give any recommendation on products. So protecting your legacy, we have wills and we have trust funds. This is how you maintain your vehicle. And I just want to read this to you from many aspects. So more problems facing families today: inadequate planning for their estates and their loved ones. Most families don't have a will and trust at all in place. 7 out of 10 adults in the UK do not have a will. In 2019, the UK government gained 33.5 million from people who died without a will. What does a will do? A proper will and trust potentially could save thousands of pounds in taxes and home fees. Trusts are used to ensure your loved ones actually receive their due inheritance. What does wills and trusts do for us? It helps us to promote family harmony. Proper estate planning promotes family harmony. Otherwise, you leave it to chance. So my question to you is, do you have children or a family who depend on you. What would happen to them if you were to die or to pass away? So in a nutshell, that is what we do at Journey-Star. But then you need to book your own one-to-one review where we go through the education, which I've already mentioned is bespoke. We look at your needs, we look at your goals, we run through the education before any products are recommended or before we refer you to our specialists who can actually give you education. So thank you so much for listening to me today. I'm sure you have some questions and I'm ready, like Alex said earlier on, ready to take any questions. So over to you, Emmanuel.
Thank you, thank you, thank you. Wow, this is very addictive. I'm just sitting here and listening to all the steps you've taken us and Alex, and I'm just asking myself, this is what we need, really. We hear very little about a lot of these things, and I believe a lot of the 63 plus who are on now have gained, and whoa, excellent. First of all, thank you all, for both of you, for the presentation. We'll take a few minute break so you can grab a drink and water your throat, and then we'll come back to some Q&As from the audience.
Wild Remit helped me give you the best start in life. Even if I couldn't be there to see it, I know it wasn't easy comparing yourself to your friends, but the money I sent home meant that you could be right there alongside them today. I'm so proud to be your mother, almost as proud as you must be now that you're starting an incredible new chapter.
Thank you and welcome back. I don't even know where to start, but to be honest, I am just shocked how much we lose out thinking we have money in our name with a bank balance, and we are reading it every day, and it's true, the banks are making more, and we just happy with what we have with 320 pounds at the end of it all. Jesus. But yeah, and hopefully financial education is what we need. Now, I've got a few questions and we'll go to Q&A now. This program has been put together with the support of World Remit, better way to send money. World Remit has been supporting us to get us through delivering these sessions. All the back end costs and everything that we had to, they have been supporting us, so we are grateful. Ghana Nurses Association, we are grateful for your partnership in this program. Western Region Nurses Association, UK, and the Nightingale Nurses Association for partnering with Ghana Union and delivering this community awareness forum, educational forum, information forum, and creating awareness for our people so they are better informed and can make well-informed decisions for their lifetime. I also want to thank the Ghana High Commission for endorsing our program, and for the personnel who are here. I have seen a few high-profile personnel from the High Commission, to say the least. Our head of Chancery, Mr. Amprichum, is on, and a few others that I'll get through. All the groups who are supporting and watching us live, we are grateful for your partnership. Thank you. Alex and Betty, thank you for the presentation. Very, very well. Very well. I couldn't ask for more. I want to ask one question. Why this is about pensions? Why do people's money get given to widows or widowers when they are not there? When actually those widows and widowers actually have their own pension. If you die and your wife is working and is having her own pension, why is it that some of your pension is given to the wife or husband. I don't know whether the husband gets some or not, but it's always widow's pension, widow's pension, widow's pension. Why is that?
Shall I take that one?
Yes, yes.
Yeah, so typically that scenario, Emmanuel, is with normally it's with a final salary pension. So let's take the NHS or local government, teachers. It's a trade-off because it's a final salary. You'll get a proportion of your income guaranteed in retirement. So that's based on obviously how many years service you've had in a particular job. Part of that security is that it will pay a level of income to your spouse, but because it's guaranteed and it's at a fixed level of income, it will typically pay the normal figure. Some of them differ slightly. Is 50% of what it was paying the original pension holder. So it's an additional benefit, more than a feature that's based on the contributions of the level of service of the original holder. The only downside to that is that it's fairly restrictive as to who that second income is payable to. So it will pay a spouse. It will typically pay a dependent, so a child that's under 18 or 21 if they're in full-time education, but it won't pay anybody else. So if you had a brother you wanted to benefit from your pension, it wouldn't pay them, for example, if it was a final salary pension, which is where if you've got a money purchase pension, so some of the ones you see more often nowadays, because you tend not to see so many final salary pensions because they're quite expensive to run because they're based on guaranteed incomes. But with flexible pensions, then if your pension is worth £200,000 and you take an income from it, then you can, if you die, you can leave that monetary amount, the £200,000 value, to anyone of your choosing if you were to die. So there's different benefits and disadvantages for different types of pensions. I think with the ones that pay a spousal income, you'll see a lot less of those now, and it tends to only be sort of government-based pensions, like civil service, fire brigade, police. Whereas you go back 20 years, 30 years ago, a lot of the FTSE 100 companies all had final salary pension schemes, but they got more and more expensive to run. So that's why they've moved over to money purchase pensions nowadays.
I see. All right. Thank you. Thank you for that, answer. Thank you. I'm going to call somebody whose hands up. But before I do, I'll ask a question on the chat room. My question is there any age that is too late to invest?
Good question. Good question. No, I would say there's not an age. It's never too late. It's a bit of a cheesy answer, but when someone says when's the best time to invest, the answer is always yesterday, because the sooner you can invest, the better. It's quite interesting to see, someone that perhaps wanted to invest in a pension when they're 20 and when they're 30, the difference and level of growth and contributions you need to put in are far more at a higher level at 30 than they would be at 20, just because you've had those extra 10 years of contributions plus 10 years of growth, and then going forward every 10 years the sum that you've got invested is compounding. But to answer the question, it's never too late. It's better to start as soon as you can and build up some form of value than it is not to do anything at all. Now, you might have the state pension, you might have some form of employment pension, but it's always worth starting something, and at any age, definitely.
Okay, thank you. There's another question here. It goes to, I believe, Betty, or any of you can take it. If somebody dies without a will and have left an estate, what are the process that the family or the dependent family can go through to at least retrieve or gain from that estate? Or is it that the person must have a will, otherwise they lose it all?
No, they don't lose it all. But then what happens is if someone dies without a will, they've died intestate, which means that now is the laws of England that will determine how everything is going to be shared. So it depends. We have different thresholds. So it depends on how much the whole estate is worth, right? So depending on that, it starts from the spouse, then to the children, and it just depends on the number of people in the family. So first of all, they would look at how much is in the estate, right, before it's distributed. But then you pay tax to the government. If you die without putting things in trust, that's why I talked about, wills and trust, making sure that your family is well looked after when you are not around. So it's so important that you have a will. It just makes you so relieved as well. It makes sure that everything that you have set to happen when you die, the right people actually inherit. Right. It might be that you have another child somewhere that you wanted to include. It might be that you want to give to charity. Whatever you want to do, it's always good to have a will so that it's clearly defined and it's done by an expert. We have solicitors who look at this, and based on the law of the land, will guide you as to how to go about it. They won't take all your money, but then depending on your estate, you can lose some of your money.
Okay. Thank you. I'll go on the room and ask Edwin, please. Edwin, to speak. Edwin Kwachi.
Wow, that was fantastic, Betty. There's so much we don't know about finances, our finance, but that we actually need to know. So what I want to ask Betty is, how much does it actually cost to get your services?
Okay, that's a good question. Thanks, Edwin, by the way. So yeah, for my service, so financial education is free, right? So you do not have to pay any initial fee to see myself. It's all about the mission of the company, providing financial education to our clients. Once we refer you to, different providers, that is where you get to pay for the services that is provided. For instance, if you now decide to go for an insurance policy, of course, the insurance policy, you'd have to pay a direct debit, and I get paid from the company that I introduce you to, right? But there's no initial cost at all. And then you don't need a set amount before you can see me. So I see everybody. That's the difference between my company and other companies out there. We see the normal Joe blocks down the road. So we don't have, a threshold. You don't need to have £50,000 before you see me. I see people where I just help them to become debt free. They have too many credit cards. So it's all about consolidation and all that. So I see everybody. I have clients who have £8 million in assets, as well as, clients who are in debt. So I see everybody, and there's no initial cost.
Oh, thank you. Thank you so much. It's good to know that. Somebody sent me a message asking, are you two happy to share your numbers? So some of them have privately want to reach out to you after that. So there's a chat room. If you don't mind, you can put your numbers there. Otherwise, I will return your numbers to that individual myself once the program is over, if it's okay. Irene, please. Irene.
Right. My question is, lately I found out that there's some individuals in my workplace taking something called flexible retirement, but I don't understand how it works, because based on what explanation those individuals have given me, I feel that it's attractive. That's first part of my question. So I want to know, just if you can give me a little bit of advice on what it is. And secondly, as you rightly said, I think it was the gentleman rightly said, the government or organizations are moving away from the lump sum pensions. And so now most people who come into employment have just the normal pension without a lump sum. Assuming that you have had a job in the past and you have a lump sum, is it advisable to take the pension sort of like age 55, 56, or you just have to wait until you turn 60 or 68? It's something that is bothering me a lot. And I just wondered if it's advisable to take it prematurely or to wait until 68, where probably you might not be able to enjoy it as much. So if you can give me a bit of advice on that.
Okay, sure. Yeah. So two parts to that question. Flexible retirement. I think the second part is not too dissimilar to that either. Flexible retirement, essentially, going back to what I was saying earlier, is that pensions do have a lot more flexibility than they used to, in terms of the income you can take from them. So whereas previously you turned the pension on, it paid an income of X, and you couldn't change the parameters of what it would do. Now you can take an income from the pension. Let's call it in round numbers, £1,000 a month, but you might still want to work part-time as well. So you might work part-time and earn £1,000 from a job, but take £1,000 income from your pension. So rather than sort of having a hard stop and retiring, 100% straight away, you could take some of your income from the pension, some of your income still by working part-time, having the best of both worlds. And then 3 years later, or whenever it might be, you can fully retire. So, and also with pensions as well, you can take, if you've got I call it a newer pension, but what they call a money purchase pension. So the money you've invested into it grows, and your income is based on what the pot is eventually worth. You can also take, when you choose to, at retirement, take a 25% tax-free lump sum from those as well. So it might be that, and I'm just presuming here, that some people, when they take flexible retirement, might take the tax-free portion of their pension, as well as taking some element of the income, but might still be working for part of the time. They might not be working, but there's flexibility with the amounts. That's how much you take from it and how you use it as well. On the second part of your question, Irene, I think you were alluding to final salary pensions. Now, if you've in the fortunate position of having a final salary pension, and it might be that you had one, someone might have had one from 10, 20 years ago, then effectively that proportion that you've accumulated in the pension is there, and it will be, person A has worked 10 years in a particular job, their final salary was £20,000, so they get a proportion of that income at retirement. Now, normally, if it's a final salary pension, they will have a defined retirement age, and it might be 60, it might be 65 or 68, but it will be set by the scheme normally if it's a final salary pension. You can take it early. Normally, there's a little bit of what they call an early retirement factor that they put in, where they reduce the income if you take it earlier than the scheme's set retirement age. With a newer pension, as long as you're over pensionable age, so as it stands at the moment, 55, which they'll gradually be putting back, then you can take that from any age from there onwards. So final salary pension is, again, in a nutshell, is very much dependent on what the scheme rules say in terms of the retirement age. But again, the flexibility, if you've got another type of pension, a flexible pension, you might be able to take that one at 55 or 56, and then take slightly more from that one until your final salary pension gets into payment, which might be 60 or 65, and then you can reduce the other pension down slightly to to keep it more in equilibrium, if that makes sense. So if you've got both types, it just means you can be a bit more flexible, both with the amounts you take from the pension, but also the age at which you access them as well. If that all makes sense.
Right. Thank you. Thank you. I'm sure that Irene will get your number and will contact you as well if you need further clarification. Thank you. Peter, please. Peter.
Hey, can you hear me?
Yes.
Thanks for the excellent presentation, Alex and Betty. My question is probably following up from, let me borrow the analogy that Betty, you talked about, which is the car and maintenance. And the typical, probably the average person, when they have something wrong with the car, they will know what to do straight away. They will probably try and go to somebody and speak to quite quickly and get it sorted out. Why do you think that in the financial industry, why do you think that people know that they have to do these things, but they're not doing it? What else can we do to change the mindset? Because if you have your car right now, you definitely will consult, even if you have to go to a second-hand mechanic to get it sorted out, you do something around that. But when you have to come to financial things and have to speak to someone, there is a reticence to do that. What do you think? Why do you think it is? And do you think it's changing? And what can we do differently?
Excellent question. Excellent question. So the problem is sometimes fear of the unknown. Most people think that all these things cost money, right? So they are looking at how much they have to pay. And I'll be honest on here, as I'm Ghanaian as well, you know, most African people think that, listen, this is something that would never happen, you know, back in wherever I come from, we don't have all these things. But then here is different, right? We have laws that govern the country, right? The same way you would not have a car without having car insurance because it's mandatory to have that. If you don't have it, you'll be stopped by the police. When it comes to things that you have to do for yourself, people feel, no, I'll do it. And procrastination, I'll do it next year. No, nothing will happen to me. But COVID has taught everybody on here that young people can die. Old people can die, anybody at all. And we know definitely there's someone that you know through this pandemic who has lost their life. So mostly it's procrastination, fear of the unknown, not knowing how much it would cost them, or people not even, you know, wanting to sit down and have that review, commit that time. I see clients sometimes, they're like, how long will this take? I'm like, listen, it's going to take anything between an hour and a half to 2 hours. This is to do with your finances. Most people have 2 jobs, businesses, all kinds. What are you trying to achieve? Money, right? To hit your goals. But if I'm showing you how you can get there a bit quicker by making good financial decisions, why won't you commit that time? You know, in seeing an expert, right? Even if you have to pay, it's to pay to better your life. If Alex is seeing you for investment, it's for you to make the 10%, 12%, but it's long term. Most people also want it now. That's why a lot of people have lost money. People have done all kinds in this pandemic. Just quick money. Everybody wants some form of quick money. So they can't commit to that time. When you sit with Alex and Alex sees you, it's going to be 5 to 10 years investment he's going to be talking to you about. It's not the short term. In the short term, you won't make that much money. Again, going back to talking about emergency fund and all that. So it's mostly fear of the unknown. Most people also don't have the education because the banks are one-stop shops. They sell products. They don't provide a total solution sometimes, right? So I see a lot of clients. They mostly have all the products I recommend. But once they understand what they have, they make better informed choices. So I hope that answers your question.
Thank you.
Thank you. Thank you, Peter. The next one I want to ask is, we have found ourselves in the times past where people have put money into certain investment in certain banks. They've gone bankrupt, and all they were told is they are only protected 85,000 from whatever was there. So how do we get people like that to actually get into that mindset that actually it's not even worth doing any of those? Because in most cases, even with insurances that we talk about, there's always small print that when the inevitable happens, that is where they take you back. And the reason why I'm saying is because of the cultural issues that you raised from where we come from, Wales and all of that. Oh, that one, you know, is when I'm about to die. Nobody even know when they're gonna die, but they say when I'm about to die. Or maybe some families you don't even talk about it at all, because the moment you mention it's like you are aiming for my life or that kind of thing. Whereas in this culture, people in 2030 have already done it. So it's cultural issue here. But my issue is where you've put money down and you have 160,000 in an investment and the company go bankrupt and you can only recover probably less than half of it. What does that do to your trust in the whole thing, the whole concept going forward? Or is it just keep trying and hoping that nothing will go wrong?
Okay, so before Alex takes that, I just want to say something. So if you see a financial advisor like Alex or any financial advisor out there, what they do is they don't just invest in one product, right? So they invest in different companies. It can be that all companies will go best at the same time. Hence, we talk about the FTSE 100 companies and all that, right? But most people actually do it themselves. They go on the internet and do it. When you sit with an expert, they will be able to go through everything from A to Z, right? Breaking everything down. Alex will talk about this, we'll look at your risk, your attitude to risk, how long you want to invest for, right? If it's to do with insurance, yes, there are fine prints down there. I explain, I break it down. I see clients, they tell me they've got critical illness, but it's terminal illness they have. Because when they tell me how much they are paying, I'm like, nah, it can't be true. So I always get them to email the details. By the time I check, it's terminal illness. Terminal illness is similar to life cover. It's just that it will be paid before you actually die, which is totally different from critical illness. And it comes with education, making time to sit with someone who would explain and break it down for you to understand. So I'm sure Alex will take the investment bit as well.
Yeah, it's a great, thanks, Betty. It's a great question because, yes, we have got these. I mean, it's good that we've got some form of protection in the UK from that point of view. But yeah, I mean, it is a big consideration when you're investing large sums of money and you want the protection that if anything were to go wrong, that you're covered. And we've seen it, you know, from time to time in the past. Different companies have gone bust, and you know, even the banks have gone into problems in the past, which, you know, we saw 2007, 2008. It's one thing, as I say, I think from a large perspective, the government would be very reticent to, or they didn't, you know, to let a bank going into receivership, and they didn't because, you know, places like Royal Bank of Scotland, Lloyds, and Northern Rock, you know, the government underwrote the banks there. If we're talking about individual investments, then Betty's absolutely right. I mean, the conversations we would, you know, and I get asked a lot, you know, I've seen this investment, should I invest in it? It's promising, you know, 15% guaranteed annual returns.
Right.
Is it breaking up?
Yes, I think it's breaking up.
Oh, it is.
Okay. That is the trouble of technology and internet. It's everywhere. So I'm sure Alex will fix something else back.
The Bank of England.
Back now.
Oh, I see. I lost you there. Yes, I was just saying, yeah, it's most important that to make sure that whatever is invested in is regulated. So it might be that, you know, if it's an investment, it's the Financial Conduct Authority. If it's a bank, then obviously the Bank of England or the Prudential Regulation Authority. The overarching thing is to make sure, you know, if you've got whatever the figure is, 100,000, 200,000, you know, it's not putting all your eggs in one basket, which is why, you know, even if someone's got a lot of cash they're sitting on, it's why, you know, if someone were to do it, we'd recommend they split it amongst different banks. So therefore you get the bonus of the protection of the individual £85,000 protections per bank. And obviously things like that, if it's a husband and wife, then they get that level each if they've got a joint account. But from an investment point of view, yeah, it's not putting it all into one particular company, not into one particular fund or one particular share. You know, it's spreading the risk. And if you've got, you know, X amount to invest, splitting it, you know, 10 ways, 20 ways is always going to be sensible to do because you're mitigating the risk and the exposure to any one particular company potentially having issues. So yeah, that's what I would say. Diversification is always good, and you know it's a much safer way of investing.
Wow, thank you very much. I'll read a few chat room questions. Somebody's asking, is this session recording for those unable to participate? Yes, we will put it on our Community Awareness Forum Facebook. If you go there, all the recordings are there. So for those who are missing it, can also share the knowledge that we are gaining today. The next one says, I'm still working and entitled to a company pension. Is it best to leave the pension to accumulate or transfer it into another pension and claim higher tax rate relief?
Okay, well,
that's one. Is it best to leave that to accumulate or transfer it so they can get much higher? Does it get any higher rate?
No, just thinking if I'm reading it correctly, the pension's already there. It's already been contributed into. It's already had the tax relief. So from that point of view, whatever's in there has already had the benefit of the tax relief. If you're still employed by the company, presumably, often you put in whatever 4%, 5%. Quite often, the company will match up to the level of contributions you're making. So if you leave the scheme, you will quite often lose the benefit of the employer also putting in their contributions. So I would always say if the employer is matching your contributions, definitely don't leave it because you're obviously missing out on a considerable amount of new contributions into it. If for any reason you leave the company, you might want to move the pension somewhere else. But the fact that it's already had the tax relief on the way in, you wouldn't get that tax relief again. But it might make sense from the point of view of if you have left that company, you might want to move it just so you've got better sight of it, more control over how it's invested, where it's invested, and then you might move companies and pick up a new pension. So rather than having lots of small pensions or pensions dotted all over the place, it might make sense to amalgamate them and get the benefit of the economies of scale by being able to manage the pension all in one place. That's what I would say is one potential benefit. But yeah, if you're still with the company and you're getting contributions into it, certainly by an employer, it probably wouldn't make too much sense to leave it because you'd be missing out on those extra contributions.
Thank you, Alex. So if I understood it right, you can only earn that relief once in your one pension. Not if you have, let's say, for instance, you have your occupational pension with your employer, and you have saved some another type of investment which may become a pension. Do you get that relief on both of them, or is it just on one of them?
It's different types. So, I mean, if you've got a pension, obviously that's had the tax relief in it. If you've got another investment over here, but you want to then take that money and then put it into a pension, then you'd get the tax relief, obviously, on it when you put the money into the pension. But depending on what that other investment is, let's say it's an ISA, then you'd be getting the benefit of it being invested in something which can grow tax-free and you can take the money out of it tax-free. So that's a different type of tax benefit. But yeah, you could take the money out of it and put it into a pension. Absolutely. But obviously then you're tying up the money for the longer term. So it just depends on what you want it to do, basically.
Okay. Thank you very much. As the question says, does your advice cover worldwide assets in Ghana? So some of the advice we are taking here, I mean, I believe it's an educational one, of course, but is there any of your advice and areas of legal wise that covers assets in Ghana?
For me, not unfortunately, sort of other than theoretical. Yeah, it's not yeah, because we're regulated.
Right. Okay.
Again, as same, because we are regulated and it depends on your jurisdiction.
Unfortunately.
Okay, sorry, Alex, you're back.
Oh, sorry. I'll start again. Yeah, from our point of view, because we're regulated, it would only cover sort of giving regulatory advice in the UK and parts of Europe. So unfortunately, Ghana would be outside of that from us because we're regulated when we give advice.
Right. Okay. And Betty, you were saying something to add to that.
Yeah, same here, because we are regulated. Every country, it depends on the jurisdiction of the country. So here we are regulated by the FCA, so it just covers us. But then there are plans of, taking Genista to Ghana and, other parts of Africa. So who knows, 5-10 years, we might have it there. But for now, it's just UK.
Okay, so also another question, that if because of the regulatory body, you are not going to be able to, your advice will not go beyond here. Why is it that in some circumstances you are made to list your assets, including all those who are not here? Especially in some cases, divorce for once, people are meant to list all their assets and then, the jurisdiction here decide who gets what in some other cases too. So why is it that when it comes to that, the jurisdiction changes, but when it comes to what we can take from here to there, it becomes a different thing? Do you have anything to share on that? You don't have to. I'm just asking a hypothetical question.
So, for instance, if we are working towards your goals, for instance, we'll take into account assets you have back home as well, because we do a lot on goals. What's your 1 year, 3 year, 5 year, 10-year plan? So we take all that. People sometimes have children back home, children here. So it depends on the family dynamics and all that. So we do take the assets so we can give you a proper financial review. Right? We need to make sure we know the assets that you have. And sometimes when it has to do with a will as well, especially if two people, if we have a couple who are divorced, someone has assets, it will be taken into account, right? And when you are putting together a will as well, it would be taken into account. So it just depends. But because it's regulated, we cannot advise you on products in Ghana, because Ghana is also under a different regulatory body. Right, they have their own rules, they have their own regulations, so we cannot do cross, country sort of investment. But then, if we are giving you a holistic, recommendation or advice, then we need to make sure that we take into account what you have here and what you have back home. Yeah.
Right. Okay. So I will. Okay, somebody's question on the chat room says, what is the difference between critical illness and terminal illness with regards to insurance?
Okay, so the difference is that with terminal illness, so terminal illness is part of life cover. Most life covers will have terminal illness as an additional benefit. So, some people are given 4 weeks to live, 12 weeks to live. The money is paid whilst they are alive. But these are people who have been given a time within which they know they are going to die, right? That is when terminal illness will pay. Critical illness, however, covers you for critical illnesses out there. It depends on the company you go for. So my company, for instance, we provide serious illness cover, which covers all of the critical illnesses as well as some, less critical illnesses. So that's the main difference. So critical illness, you have to pay separately. It's separate to life cover. But terminal illness, most of the times, is included in the life cover. So you pay for your life cover and you have the additional benefit of terminal illness, but critical illness is separate. You need to pay. So I think they've asked another question. What is an example? So yeah, having cancer, having stroke, yeah, that is classified as a critical illness. That's an example.
Thank you.
Even loss of eyes and all that can be classified under that.
Right, okay. We will give you a few minute break again. We will have 20 more minutes. I've got more questions here, but I will give you a few minutes, take a drink. We will come back. We have a lot more questions that I've just received, some on WhatsApp from, from Facebook and others that came earlier. So we'll do a few commercials, then we will go through one or two things for the next session, then we will return to the Q&A, please. Thank you.
This program is brought to you by WorldRemit, a fast, reliable and better way to send money.
WorldRemit helped me give you the best start in life. Even if I couldn't be there to see it. I know it wasn't easy comparing yourself to your friends, but the money I sent home meant that you could be right there alongside today. I'm so proud to be your mother, almost as proud as you must be now that you're starting an incredible new chapter.
Okay, so the next program that we have will be taking place. For diary reasons, we have to move it to 3 weeks from today, which will be the 22nd of October. We will be discussing security in Ghana, being security aware and security conscious. We'll have a town hall meeting with the Commissioner of Police, responsible for police administration in Ghana, Director General. We are coming up to Christmas. Some of you are planning to go to Ghana. Some of you are traveling around the area. And we all know, yes, as much as there are a lot being done, there are still some hot spots that we need to be aware. So we've taken the initiative and the commissioner has kindly agreed to come and interact with us and show us some of the things that we as diasporans need to be aware when we are in the country and traveling up and down the country so that we can be safe and secure in our homes and on the road and areas that we have become aware of. So on the 22nd of October, we will be holding a town hall meeting with the Commissioner of Police, Director General of Administration of Ghana Police Service. Please join us. When you get the flyer, tell others to come and listen, join us to share the message around so that we have people to interact with and gain awareness and knowledge from. Thank you so much. As I said last time, I'm going to share my screen and we'll be going through one or two questions that WorldRemit, who is a sponsor for this program, has given us. As I said last time, we want to do a draw. It's either we do it once a month or we do it at the end of the 2 months, which will earn you the same amount of £100 or 50 if we're to divide it. But because of technical reason, we couldn't do the draw today. And I promise you, we are going to get it done. But in the meantime, I'll go through these questions with you so that, right, sorry. Right, that's some of the pre-advanced questions I received earlier. Right, okay, where is the, right, okay. So, WorldRemit want us to have a bit of education with you. We've gone through these questions. We are going to get a draw day where you earn £100 if we do the September and October together that you can use to support somebody back home. Which of the following ways can you send money using WorldRemit? The answers are there: cash pickup, transfer, mobile money transfer, airtime top up, all the above. How many countries can you send money using WorldRemit? you need to go to the website, search for the answers, because when we do, we want someone to gain that money and use it to help somebody else. For how many countries can you receive money? So you have number of countries you can send from and the number of countries you can receive the money. Which of the following platform can you use to send money? Is it mobile app or website or mobile and app and all the above? How much can I get if I refer a friend to use World Remit? You get a token, voucher, or money straight away if you refer somebody to use their service. And which of the following mobile money transfer companies are partnered with World Remit in Ghana? If you send the money, is it me, MTN, Airtel, Vodafone, or all the above? In what currency can I receive my money in Ghana? Is it in pounds, dollars, Ghana cedis, or Ghana and the dollars? Do your recipient need mobile money accounts? Is it either yes or no? And why will you choose World Remit? Is it because it's simple, reliable, fast and safe, low cost, or above? And which year did World Remit started its money global money transfer operations? Is it 2009, 10, 11, or 12? And what do I need to create World Remit account? Do you need an email? Do you need your full name? Do you need a password? Do you need sending country or the above, or all of them? And so we'll be going through this as part of the next 2 weeks. By that time, we would have got things resolved and hopefully we will get the draw done. Welcome back again, Alex and Betty. Thank you for staying through this session, 2 hours. We'll be rounding up soon, but a few questions that I have that I need to ask you before we go back to those who have their hands up. We still have some time, so if you have any questions, please raise your hand and we will go through with the panel. Right. When is the best time to take your pension lump sum? That's one question somebody wants to know. Number 2, what is the advantage of premium bond? The person actually sent about 3 or 4 questions, so I will leave the 2 to be answered. Okay. What are the advantages of premium bond, and when is the best time to take your pension lump sum?
Perfect. Thanks, Manuel.
I'll ask the rest.
Yeah, thank you. Yeah, thank you for breaking them down, because if there was 4 or 5 questions, I'd no doubt forget them all partway through. So appreciate that. Yeah, so when's the best time to take your pension lump sum? There's not necessarily a one-size-fits-all answer, because it's very much dependent on the person. Because if someone has a need or a want for what they're going to do with their pension lump sum, then it's probably going to be at a sooner point than someone that hasn't got a reason for it, straight away. Someone might want to pay off, a common reason is to pay off a mortgage at maybe age 60. But if someone's in the nice position of already paying off their mortgage, then they might not need to take it at 60. They might take it at 65 and spend it on something else. And obviously the tax-free pension lump sum is based on a value, and typically, the later you take it, the more that value is. So by taking it as soon as you can, if you haven't got a reason to take it at that point, I'd say it might not be the best advice to take it straight away. You could leave it in place for a few more years and then take it. So it really depends on the person's circumstances and what they want to do with that lump sum. But if it's to pay off debt or mortgage or other reason, then that's a very good reason that they would take it. If they haven't got that reason, just taking it for the sake of it is not necessarily the best way of doing it. It might be best to leave it for a little bit later. But yeah, that's very much a personal decision based on that. Premium bonds. What I was saying earlier on in my talk was, the good thing about premium bonds is that they're guaranteed by the government. They're safe, they're secure. You've got reasonable access to them in terms of timing. There's always the potential of winning the prize. So they've changed it slightly in terms of, I mean, you can't say the guaranteed returns of a premium bond because it's down to, technically it's down to luck because it's a draw. But they always used to say if you average it out over the course of a year and you get, a £25 win and a £50 win here and a bigger win, it used to average out, if they average out amounts, every single person that's got a premium bond was about 3% a year, averaged out. It's a little bit less now because the prizes, they've changed the prize winnings, the way they do things on the draws. But yeah, I mean, it's guaranteed. So, you put in 20,000 or 30,000, that's safe. It's going to be a minimum of that value when you take it out. And it's protected by the government. So, from a protective point of view, it's a very safe type of investment with the possibility of some returns and potential of a big win, as well potentially.
Thank you very much. What is equity release all about? And so next one is, how do you go about putting your investment and property into trust? So what is equity release all about? And how do you go about putting your investment and property into trust? These are another two sets of questions. Then we'll move on to other ones.
Okay. Did you want to do equity release, Betty? Or?
You can take any of these, yes.
I'll do the trust, so you can do that.
Okay, perfect. So equity release is essentially, so you've got, from a mortgage point of view, you take a mortgage out to help you buy a house. Equity release, you already own the house, but you're looking to utilize it to provide some form of income or capital for you. So normally, let's say your house is worth £300,000 and you're age 70. You might be that you haven't got much in the way of pension or much in the way of investments, but you've got a £300,000 house without a mortgage on it, that's sitting there, with a decent value, and you're wanting to make that work in your favour. So equity release is, as it says, releasing some of the equity in it, and it's percentage based, so that the older you are, the more equity you can release, and effectively you can draw the money from the house and take that as income or take that as a capital sum. And there's all manner of ways at which you can pay it back. You can either pay interest on it, or just pay it back when you die or when you sell the house. So there's a lot of people of a certain age that have got houses of quite a lot of value, but they perhaps haven't got a lot of other investments or pensions. So it's one way of releasing capital that they can enjoy, and utilize more effectively and beneficial for themselves.
Yeah, and then looking at trust as well. So the question was to do with trust, right? How can you put your house and all that in trust? So yeah, I talked earlier on about having a trust or a will, which makes sure that whatever property you have will go to the named person that you want it to go to. So the way you do it is you sit with a solicitor or any advisor who can advise on trust, and they will go through again what you have, what you want to leave, because these are legal things that you do. So I know a lot of people, you can go on the internet and even have a will or a trust done, but it's always good to sit with an expert, because we have complex cases, we have situations where people are separated, tenant in common. There are so many different situations. So it's always good to sit with an expert. Once you sit, they'll review your whole situation and will be able to advise you, because it's not everybody who can. It depends on even the age of the person and all that. So there's a lot that comes into effect when it comes to having a trust or having a will. But at the very least, when you have a basic life insurance, for instance, it's always good to put in trust. right? Because it's just a simple form that you fill, just showing 50% goes to my husband, 25 goes to this daughter, and that 25 goes to your son. But it's always important that you put it in trust or you have a will in place.
Right. Thank you very much. There's a question here. Why, it says, life assurance, why does life assurance assured continue to reduce as you get older? I have had 20,000 taken off my life assurance as I was unable to increase my monthly payment from £59.99 to £99.
Okay. So yeah, it's a bit, okay, so let me see if I can understand this correctly. So first of all, if your sum assured is decreasing, then it means that you have a decreasing term life cover, which means that every year the sum assured will decrease, right? But then sometimes if you have indexed as well, you have indexed where the price, the premium that you are paying also goes up. And again, it boils down to financial education, because most people don't even understand what they have, especially when people are buying a property. There's so much excitement and they are so much in a hurry. They just, yes, yeah. They just sign, right? Without paying attention to the detail. If you have decreasing, I've seen clients where they tell me that, listen, it's £400,000. I still have 400. And by the time we check, it's about maybe 300,000. And again, it's because they have a decreasing term. You can have a decreasing term where your premium is fixed, right? And then you can have a decreasing term as well, or a level term. The difference is the level term, the sum assured stays the same throughout the policy. Decreasing term decreases, and most people do that with their mortgage, because as the mortgage amount is reducing, the life insurance is also reducing. But if it's to do with having a life insurance legacy and all that, it's not, recommended that you actually have a decrease in, because you want the amount to stay the same throughout. But if you have indexed as well, then the premium can go up.
Right. Thank you. If you have a money purchase pension in a previous employment and a final pension scheme in your current employment, is it wise to transfer it to the final salary pension?
Good question. It's rather more complicated to do it that way. Essentially, the way a final salary pension works is it's done on your final salary, the number of years service you've had in the scheme for the employer, and also the rate at which it accumulates. So depending on the scheme, it'll either be based on the number of 60ths or 40ths. So the way to explain it is if you've done 40 years in a job and 40 60ths is the same as saying 2/3. So effectively, that's what it's based on. You'll get 2/3 of your final salary. Now, if you've got a money purchase pension, and let's say in the same respects, you've done 38 years and it's 38 60ths, and your money purchase pension is worth £50,000, it can be done, but what has to happen is that your final salary scheme, the trustees of it have to agree that you can move it into the final salary pension, but they also have to carry out a calculation to say what is that £50,000 worth in terms of the number of years in the final salary scheme. So you're comparing two completely different types of plans. It can, in theory, be done. It's fairly complicated because the trustees of the final salary pension have to agree to it, and they also have to calculate how much pension that money purchase pension can buy into the final salary pension. So it's by no means an easy exercise, but it might be worth a question to your pension trustees if they will be willing to consider it. Right.
One final question. What are the best areas of investment currently in the UK from your expertise? Well, if somebody has something to put down to invest.
Okay. In terms of how it's invested.
Yes.
Yeah.
You know,
Okay.
some pointers as to investment areas that you think.
Okay. There's the $64 million question. What I would say, if we're looking at the long term, the best answer, if you're looking for growth, it's in a globally diversified equity portfolio. So, there's always going to be a particular sector that does well at a particular time. I mean, technology shares have done fantastically well over the last 12 to 18 months and longer. They've had a very good run. Before that, healthcare stocks had a very good run. There'd be different sectors at different points of time will do well. Different countries will do well at particular times better than others. Compare technology shares, which have done well. The US stock market has done fantastically well over the last few years. But we can't say, obviously, that it's going to keep continuing to do that. So the long and short of it is, if you're as diversified as possible and globally diversified, then that's probably the best way of approaching it in the medium to long term, I would say.
Thank you. Betty, any thoughts, any add-ons, or you're okay?
So like Alex said, it's more about, having a diversified portfolio. So again, it boils down to what your goals are. Property has also, done well as well, so that's a good way or a good place to also invest in, as well as long-term products. But it all boils down to your goals, to be honest. Where is it that you want to get to in the next 1 year, 3 years, 5 years, and 10 years? That is what will drive you to the investment that you would go for.
Thank you both so much. The Ghanaian Community Awareness Forum is grateful. The audience are grateful. We couldn't be more thankful for the time you spent, the expertise, and the knowledge you've shared with us. I hope we can continue to call on you for this sort of educational program, because we do need it. I would like to thank you for your time and everything you've put in. We are grateful. I also want to thank Martha Nugent, who through her effort managed to link us together to this program. She highly recommended you from your last presentation with her group, and I'm glad you were able to take the offer to appear here. Thank you very much. We want to thank all the audience for being here. That is all time will allow us to bring it to you. Don't forget, next 3 weeks, we are doing security awareness in Ghana. We have Commissioner of Police, Christian Tete-Yaunu, Director General of Police Service, Police Administration here with us, and he'll be taking us through all the tips and all the hot spots that we need to know. He's a man that has crime and policing in his at his fingertips, and he can give us a lot to learn from. So please share with other people so they can join us. We thank the technical team for bringing this together so nicely, and we thank everybody whose work has made it successful for us to do this work with you. We hope that you will continue to patronize this program. It is important that you do, because all we are doing is to give you information that otherwise you probably not have it elsewhere. Thank you. Ghana Nurses Association, thank you for your partnership. Ghana Union, thank you. Western Nurses Association, thank you. And Nightingale Nurses Association, thank you. We want to thank the Ghana High Commission for endorsing the program, and Omega Live for bringing it to our audience on Facebook, and also all the other supporting groups, including World Remit, for sponsoring us. Alex and Betty, we wish you well, and we will be in touch again. I definitely will reach out for more sessions of this in the coming months to come. Thank you very much for such a stellar job. Thank you. And good night. Have a good weekend in advance.
You too, and everyone else. Thank you.
God bless you all.
You're the best.
This program is brought to you by World Remit, a fast, reliable, and better way to send money.
World Remit helped me give you the best start in life. Even if I couldn't be there to see it. I know it wasn't easy comparing yourself to your friends, but the money I sent home meant that you could be right there alongside them today. I'm so proud to be your mother, almost as proud as you must be now that you're starting an incredible new chapter.